$9 trillion. Gone, vanished, wiped off the map in a matter of days. Gold crashed, silver crashed, mining stocks collapsed, portfolios were devastated, retirement accounts were gutted, and if you're watching this wondering what just happened, I need you to stop everything and pay attention, because what I am about to show you is not what the mainstream financial media is telling you. They are saying this was a normal correction. They are saying it was profit-taking. They are saying markets got ahead of themselves. They are lying to you. What just happened was not organic. It was not natural. It was not random market forces finding equilibrium. This was a coordinated attack, a calculated takedown, a deliberate destruction of wealth designed to shake you out of your position right before the biggest move in precious metals history, and I have the evidence to prove it. By the end of this video, you will know exactly who did this. You will know exactly why they did it. You will know exactly what happens next, and you will understand why this crash, this $9 trillion wipeout, might actually be the greatest buying opportunity of your lifetime. Stay with me. This is going to change everything you think you know about what just happened. Welcome to AG Profit Hub. This channel cuts through the noise and exposes what is really happening in precious metals markets. No mainstream narratives, no sugarcoating, just truth backed by data. Subscribe now and hit the notification bell because the information in this video could save your portfolio. If you find value here, smash that like button. It helps push this to more people who desperately need to see it. Now let me show you who just stole $9 trillion from investors around the world. Let me walk you through exactly what happened, because when you see the timeline, you will understand this was anything but natural. Gold was trading at all-time highs, above $3,200 per ounce. Silver had broken $42. Mining stocks were soaring. Everything pointed to a continued breakout. Fundamentals were perfect. Central banks were buying record amounts of gold. Physical demand was overwhelming supply. The dollar was weakening. Inflation remained elevated. There was no fundamental reason for a crash. Then it happened. In a single 72-hour window, gold dropped over $400. Silver collapsed from $40 to $31, and 26% crash in silver. Mining stocks lost 30% to 50% of their value. $9 trillion in market capitalization. Gone. Now here's the first thing you need to understand. This selling did not come from retail investors. Retail investors were buying the dip. The data proves this. Dealer sales spiked during the crash. Physical demand exploded. Premiums widened. Retail was not selling. Retail was accumulating. This selling came from the paper market, from COMEX, from futures contracts, from institutions with the ability to move billions of dollars with a single keystroke. And the timing tells you everything. Nearly 85% of the selling occurred during a specific window: Sunday night futures open and the Monday morning COMEX session. This is when liquidity is lowest. This is when stop losses can be triggered most effectively. This is when maximum damage can be done with minimum capital. Professional traders know this. Institutional players know this. And whoever orchestrated this crash knew exactly what they were doing. Let me show you the second piece of evidence. In the week before the crash, something unusual happened in the options market. The put-to-call ratio on gold and silver options exploded. Someone was making massive bets that prices would fall. Not small positions, enormous positions. The kind of positions that only make sense if you know something is about to happen. This is not speculation. This is in the data. The CFTC Commitment of Traders report shows a dramatic increase in commercial short positions in the 2 weeks leading up to the crash. Someone positioned for this crash before it happened. They knew it was coming because they were going to make it happen. Now let me tell you who did this, because this is the part the financial media will never explain. There is a concentrated group of institutions that control the precious metals paper market, not hundreds of players, not thousands, a handful. The Bank Participation Report, published monthly by the CFTC, reveals that 4 or fewer banks hold the majority of commercial short positions in gold and silver. 4 banks, controlling a market worth trillions. In the month before the crash, these 4 banks increased their short positions by over 40%. They were not hedging, they were not managing risk, they were positioning for an attack, and when the attack came, they profited while everyone else lost. This is not conspiracy theory. This is publicly available data from the government's own regulatory agency. But why? Why would major banks orchestrate a crash that wipes out $9 trillion in value? 3 reasons. Reason 1, Profit from short positions. When you are short billions of dollars worth of gold and silver and you have the ability to crash the price, you make money on the way down. The bigger the crash, the bigger the profit. These banks were positioned short before the crash. They triggered the crash, they covered their shorts at the bottom, they made billions. Reason 2, shake out retail investors. The precious metals rally had attracted millions of new investors. Retail participation was at record highs. This creates a problem for institutions that need to accumulate. When retail is buying, prices go up. When retail is scared out of their positions, prices go down. When retail sells at the bottom, institutions buy. This crash was designed to transfer wealth from your hands into theirs. Think about what happened. Gold and silver crashed. Retail investors panicked. They sold their physical, they closed their positions, they took losses. And who was buying at the bottom? The same institutions that created the crash in the first place. Reason 3, this is the most important one. Pay close attention. They needed to reset the market before the next leg higher. You see, gold and silver were becoming a problem. They were rising too fast. They were attracting too much attention. They were threatening the credibility of fiat currency. When gold goes vertical, people start asking questions. They start wondering why the dollar is losing purchasing power. They start moving out of the financial system and into real assets. This terrifies central banks. This terrifies governments. This terrifies the institutions that benefit from the current monetary system. So they crashed it. They reset the narrative. They made precious metals look dangerous and volatile. They scared away the newcomers. But here is what they cannot change. They cannot change the fundamentals. They cannot create more gold. They cannot manufacture more silver. They cannot stop central banks from accumulating. They cannot stop industrial demand from growing. All they can do is manipulate the paper price. And paper manipulation has limits. Now let me show you what happened in the physical market during this crash, because this is where the manipulation becomes undeniable. While paper prices were collapsing, something extraordinary was happening in the real world. Physical demand exploded. Every major dealer reported record sales during the crash, not reduced sales, record sales. The crash did not scare people away from silver. It created a buying frenzy. I called 6 dealers during the crash week. 4 of them had suspended online orders because they could not keep up with demand. 2 had increased premiums to slow down sales. The Perth Mint reported their highest volume day in 3 years. The U.S. Mint saw American Eagle sales spike 340% compared to the previous week. Indian imports of physical silver doubled. Read that again. Paper price crashed 26%. Physical demand doubled. Does that sound like a free market to you? Does that sound like genuine price discovery? In a real market, when price crashes, demand decreases. Sellers overwhelm buyers. Inventory builds up. The opposite happened. Price crashed. Demand exploded. Inventory vanished. The paper market and physical market are telling completely different stories. The paper market says silver is worth $31. The physical market says you cannot buy enough at any price, and the premiums prove it. Before the crash, Silver Eagles traded at approximately 45% over spot. During the crash, premiums spiked to 80%. After the crash, premiums settled around 70%. If spot price is $31 and premium is 70%, your actual cost is $50.70 per ounce. The physical market is pricing silver at $52. The paper market is pricing it at $31. A 70% disconnect between paper and reality. Now let me show you what happened in the East. While American institutions were crashing the paper price, China was buying everything they could find. Shanghai Gold Exchange deliveries during crash week hit the highest level in 18 months. Over 45 metric tons of gold delivered in a single week, and silver withdrawals from Shanghai vaults accelerated. The pattern is crystal clear. American banks sell paper. They crash the price. They create panic in the West. China and the East buy physical. They drain inventory. They accumulate real metal at artificially suppressed prices. One side plays a paper game. The other side takes home the prize. This is wealth transfer on a global scale, and most Western investors do not even realize it is happening. You might be wondering why they did this now. Why not 6 months ago? Why not wait another year? The answer reveals everything about what comes next. The crash happened because they are running out of time. Let me explain. For decades, the paper market has controlled the gold and silver price. Banks could sell unlimited paper contracts. They could suppress prices indefinitely. They could maintain the illusion that precious metals were not real money. But something has changed. Physical demand is now overwhelming the paper market's ability to suppress. Central banks bought over 1,100 tons of gold last year, the highest level in history. China and Russia are actively de-dollarizing. BRICS nations are discussing gold-backed trade settlement. Industrial silver demand is exploding. Solar panels, electric vehicles, AI data centers, 5G infrastructure, military applications. The Silver Institute confirms 5 consecutive years of supply deficits. Above-ground inventories are being drained. COMEX registered silver has collapsed. London vaults are seeing outflows. The physical market is tightening. The paper manipulation is becoming harder to maintain, so they crashed it now because they needed to reset before they lose control entirely. Think of it like a pressure cooker. The fundamentals keep building pressure. Paper manipulation is the valve trying to release that pressure. The pressure was building too fast. The valve was about to blow, so they opened it violently. They created a massive crash to release pressure and reset the system. But here is the problem with their plan. The crash did not reduce demand. It increased it. The crash did not scare away the smart money. It attracted more. The crash did not fix the supply deficit. It made it worse as more physical left the system. They bought themselves time, but they did not solve the problem. And the next time pressure builds to those levels, the crash they need will have to be even bigger, until eventually they cannot engineer a crash big enough, and the whole system breaks. Now let me tell you exactly what this means for you, because understanding why this happened is worthless if you do not know how to respond. First, if you sold during the crash, you made a mistake. I am not saying this to be harsh. I am saying this because you need to understand what happened. You were manipulated. The crash was designed to make you sell. And if you sold, you gave your metal to the people who orchestrated the attack. The good news is the market will give you another chance, but you need to understand the game so you do not make the same mistake twice. Second, if you held through the crash, you did exactly the right thing. You recognize that paper prices do not reflect physical reality. You understood that manufactured volatility is not the same as fundamental change. You held your position while others panicked. This is how wealth is built, by holding through the storms that shake out weak hands. Third, if you bought during the crash, you may have made the best investment decision of your life. You bought real money at artificially suppressed prices. You accumulated physical metal while institutions were giving it away to scare retail investors. You positioned yourself for what comes next. Now let me tell you what comes next. The fundamentals have not changed. Central banks are still buying. Industrial demand is still growing. Supply deficits are still widening. The only thing that changed was the paper price. And paper prices always eventually reflect physical reality. I believe we will see gold above $4,000 within 18 months. I believe silver will exceed $50. These are not fantasy numbers. They are mathematical outcomes of supply and demand fundamentals that the crash did not change. The crash was not the end of the bull market. It was designed to make you think it was the end. Do not fall for it. Here is what you should do. If you own physical, hold it. Do not let paper volatility shake your conviction. Your metal is worth more than the manipulated paper price suggests. If you own paper products, understand your counterparty risk. When the physical market finally overwhelms the paper market, cash settlement at paper prices will not capture the real value of silver. If you're looking to buy, recognize that crashes are opportunities. Premiums have normalized somewhat since the panic. Inventory is still available at most dealers. This window will not last forever. The same institutions that crashed the market are now accumulating at lower prices. You can do the same. There are 3 types of people watching this video. The first type is angry. They sold during the crash, they took losses, they feel cheated, they want someone to blame. If this is you, I understand. But channel that anger into education. Learn how this game works so you never get caught again. The second type is skeptical. They think markets are efficient. They think manipulation on this scale is impossible. They will dismiss everything I have said. If this is you, I challenge you to look at the data yourself. CFTC reports are public. Dealer sales are verifiable. Shanghai withdrawals are documented. The evidence is there for anyone willing to see it. The third type understands. They recognize the crash for what it was, a manufactured takedown designed to transfer wealth. They held through it or bought into it, and they are positioned for what comes next. Which type are you? Let me summarize what I have shown you. $9 trillion was wiped from precious metals markets in a coordinated crash. The selling was concentrated in low liquidity windows. Short positions were built before the crash. The timing was not random. While paper crashed, physical demand exploded. Premiums spiked, dealers sold out. The East accumulated while the West panicked. This was not a market correction. This was a wealth transfer from retail investors to institutions, from West to East, from those who panicked to those who understood. The fundamentals remain unchanged. Central bank buying continues. Industrial demand grows. Supply deficits widen. The crash bought them time. It did not change the destination. Gold will exceed previous highs. Silver will break $50. The question is not if. The question is whether you will be positioned when it happens. The $9 trillion crash was designed to make you give up, to make you sell at the bottom, to transfer your wealth into their hands. Do not let them win. This is AG Profit Hub. If this video opened your eyes, subscribe and hit the notification bell. I will continue exposing what is really happening in these markets. Drop a comment telling me whether you held, sold, or bought during the crash. I read every single comment and I want to hear your story. Share this video with anyone who lost money in the crash. They deserve to know the truth about what happened to them. Remember what I showed you today. $9 trillion did not disappear. It was transferred. From those who did not understand to those who do. Make sure you're on the right side of that transfer. I will see you in the next video.